Welcome back, everybody. So today I want to talk about three companies that I believe are very high quality companies that don't necessarily get the recognition that they deserve. And by that, I mean these are companies that rarely get discussed on YouTube or in other financial media in general. But despite that, I believe these are very strong businesses that are worth understanding very well since they do present very compelling long-term upside potential. I do often get asked by my subscribers what companies I'm looking into, and recently I've been placing a greater emphasis on higher quality companies, companies with defensible economic moats and long-term competitive advantages, as opposed to what I was doing before, which was more looking for special situations in smaller cap stocks that was causing them to be undervalued. Now, before I get started, I do want to quickly mention that what I'm going to talk about in this video is my own personal opinion, and you should always do your own research before investing your own money. And what I'm really hoping you'll get from this video is more of an appreciation for the boring businesses, the businesses that kind of operate in the background that you don't always hear about, but still offer very good value at the right prices. So without further ado, let's just dive right in. So the first company I want to talk about is Pool Corp. This is a company that has actually performed rather poorly recently. As we can see, they're actually down slightly so far this year. And the reason this company caught my attention initially was because of the number of notable super investors that own them. My website here is showing that 6 different super investors that I track currently own this stock. And usually when you see this many of these super investors owning one specific company, it's because that company has a strong competitive advantage and a very good return on capital, which we can see here is the case with Pool Corp. Return on invested capital is so consistently high that it almost doesn't make sense. When I first came across this, I was very confused how a company called Pool Corp was earning roughly 30% ROIC pretty consistently. But once I began learning about the company a bit more, it started to make sense. So what Pool Corp does is, surprisingly, they sell pools and pool maintenance products, primarily as a wholesaler. So their customers are the actual pool retailers, or it can be trades workers that do pool maintenance for the end customers. And when you hear that, you may think, well, how does a company in that business possibly have any sort of defensible moat over the competition? But it's actually a pretty simple answer. For starters, they own the largest pool distribution network in the industry. And when you're the biggest distributor of any product in any industry, you have a lot of leverage over your suppliers. So you can negotiate cheaper prices and then offer those cheaper prices to your end customers. And we can see pretty clear evidence of this in their revenue growth rates. They're typically in the 7 to 10% range, although this did get a huge boost in demand back in 2021 due to the stimulus and the low interest rates that we had back then, which allowed housing construction activity to pick up, and pool construction is highly correlated with growth in new housing units. And this has since leveled off quite a bit. But over the long term, it's usually around 7 to 10% annualized revenue growth. And this annual rate of increase is higher than what the overall market growth rate for this industry has been, which means they're gaining market share and have been gaining market share for a long time, which I think speaks to how dominant their position in the industry is. They work with over 2,000 suppliers and sell to over 120,000 customers, and they are the middleman between them, and they're the largest one by a lot. And since they operate over 400 sales centers worldwide, it allows them to deliver products to their customers cheaper and faster than their competitors can. So you could also call it a location-based advantage that allows them to offer the best prices because of their massive scale. The next largest competitor is the privately held Heritage Pool Supply Group, who are roughly a third of the size of Pool Corp in terms of their revenue and their distribution network. What's also interesting is how they generate their revenue. Only about 14% of their revenue comes from new pool installations. The vast majority comes from servicing existing pools, so products like equipment and chemicals, or upgrading existing pools. So this does help insulate the business from the cyclicality you get with new pool construction, which does fluctuate a lot year to year depending on things, like I said before, interest rates, which influence the demand for new housing units and home improvement projects. But the demand for pool maintenance products is very stable because pools will always require maintenance once they are installed. And since the total number of installed pools is constantly growing each year, there's this natural compounding nature to their business model. cyclical. So the business is still cyclical, but most of their revenue base is very stable and should grow over time. And this is why the company has been performing poorly more recently and why sales are down in the most recent year, because the new installations part of their business has suffered as interest rates have gone up. But this is starting to change. Interest rates are starting to come down. So once this trend reverses and demand starts to pick back up, then what you're left with is a company that is dominant in its industry and has this scale-based economic moat that can reliably grow revenue around 7% annually. And we've also seen operating margins expand over the years because revenue grows at a higher rate than their operating costs grow at. So all these things together seem like a very high quality business to me. And what I'm really waiting to see is how things like new housing construction starts trending, since right now it is expected to decline in 2024. But depending on how fast rates get cut, this could pick back up towards the end of next year. So the next company I want to talk about is Fiserv, which is one of the largest fintech companies in the world. Currently, their market cap is about $119 billion. Now, what makes this business interesting to me is how they basically have two different business segments that each have their own unique economic moats. And in my opinion, they're both very strong moats. There is the merchant segment and the financial segment. So for the merchant segment, you can basically think of this business as the underlying technology that merchants need to accept payments from their customers. So they're not a payment network like Visa or MasterCard, they're more like a payment processor. So the moat that this business has is really two things: switching costs and the network effect. The switching costs happen because once a merchant integrates with Fiserv, it's very costly for them to switch away. It would really disrupt their business because they'd have to reconfigure their whole payment processing setup. And then because you have so many merchants already using Fiserv, that software providers that also have a payment processing component to their software, so software like accounting systems or e-commerce websites, they see benefit in integrating with Fiserv, which in turn attracts even more merchants who also want this compatibility with their software, thus creating a network effect. And then there is the financial segment, which is roughly the same size as the merchant one. This business provides a lot of the core banking services to companies like financial institutions and credit unions. So services like processing account transfers, deposit account record keeping, digital banking, card issuing, and several others. And because this core banking software is mission critical to banks, Fiserv is essentially the general ledger for all bank accounts. It's become deeply integrated into the operations of these financial institutions. So switching away from Fiserv would be very costly and very disruptive to the businesses. So their client base is extremely sticky. Their contracts are typically long term in nature, usually between 3 and 7 years, and they consistently have very high retention rates, over 90%. And revenue is based primarily on the number of transactions processed, so not the actual dollar value, which gives them a very stable and very predictable source of revenue. To be honest, this is probably a company that I'd imagine is going to get some antitrust attention at some point in the future. Maybe not for a while, but just because of the way they have their contract set up, they do a lot of cross-selling of their services. This does seem like the exact type of company that eventually is going to get attention from the antitrust regulators. So Fiserv is a company that will reliably grow revenue around 7 to 10% per year going forward. One of the reasons for this is just from inflation, which would probably account for 2 to 3% of that, but then also because of this big trend that's happening in their industry, which is the growth of digital payments. People are increasingly making purchases online or using mobile payment apps, so this creates demand from businesses to offer these digital payment options to customers, and this is exactly what Fiserv does. And their operating margins right now are at 27%, and these have been expanding over the years because revenue has been growing at a faster rate than operating expenses, which shows the operating leverage that the business model has. The company has also been very active in acquiring companies. The most notable one came in 2019 when they acquired First Data, which was a huge acquisition at the time. And this was really a transformative acquisition for them because it allowed Fiserv to offer an end-to-end payment solution, everything from card issuing to merchant acquiring. And First Data was primarily a merchant acquiring business, which is a market that is expected to continue growing at around 8 to 10% annually going forward. And Fiserv takes a percentage of the transaction value for payments that they process. So they will directly benefit from this ongoing trend. It also gave Fiserv the Clover business, which is a very fast-growing payment system that targets primarily small and medium-sized businesses. So what this acquisition really did was enhance their own portfolio of products and services and also give them access to very fast-growing markets that they weren't previously in. Now, even though the business has these attractive qualities, right now it does look very expensive, especially after it's up over 50% year to date, despite only growing revenue by 7% year over year and growing free cash flow by 23% as of their most recent quarter. And they currently trade at a PE of 38, which is above average historically for them. Now, if we were to try and actually value Fiserv using the DCF method, assuming a 7% revenue growth rate and 30% operating margins, and also a 15x terminal multiple, which is the EV to EBITDA multiple, which is about where they trade at right now, and we check what this will calculate as, we can see they are actually slightly overvalued at their current price. Current price of $201, and this gives us an intrinsic value of just over $190. So Fiserv is currently trading at around a 15x terminal multiple, which I'm using the enterprise value to EBITDA multiple for this. But personally, I think this multiple is quite low considering what the business is. I see this as a very high quality business, and investors have started to realize this over the years. We could see their multiple was gradually expanding before it kind of got thrown off around this time period. But generally, with companies with strong economic moats, what you see over time is multiples like this start to expand because as the moat gets bigger and the business gets stronger, investors start to realize that this company's going to be around for a long time. So there's a lot of long-term value there, which usually gets reflected in a high multiple like this one. And if we compare them to, say, a company like Visa and see what their multiple is, we can see it's going to be a lot higher for Visa. So Visa has a 25x, about a 25x terminal multiple, whereas Fiserv is much lower at 15. So yes, Visa is probably a better business, all things considered, than Fiserv is, but is it worth an additional 10 turns of EBITDA more? To me, that does seem like a bit of a stretch. So I do think there is a case to be made for this company being more undervalued than it seems at first glance. Now, the final company that I want to talk about is H&R Block. This is a company that's had a pretty good 2024 here. They're up about 23% so far, primarily because of their very generous share buyback program, which allowed them to show 16% growth in EPS, despite just 4% top line growth, and also some strong growth in their DIY service, which was up 11% year over year. Now, this is not a business that I would say has an economic moat, certainly not to the extent that Fiserv does. However, the business does have some very favorable qualities, in my opinion. For starters, they have brand recognition and a very large network of retail locations, over 8,000 in the US. So, for a lot of people that need to get their taxes done and would rather work with someone in person because they have a more complex return or it just helps them feel better about completing their return, H&R Block will be their first choice. There's also a small element of switching costs because they can retain their client's tax history, which makes being a repeat customer more efficient and less of a headache. Also, the tax filing industry is very stable. It's something that is never going to go away, and tax laws are only getting more complicated over the years as new rules keep getting added to the tax code. So, increasingly, companies and individuals are going to need a professional to help them with their taxes to deal with all this complexity. And so all of this has allowed H&R Block to consistently have very good returns on invested capital, ranging from 20% all the way up to even 45% in the recent years. And returns on capital like this will attract competition. And one of the reasons why their stock price was essentially flat a few years ago was due to the threat of competition, specifically with Intuit and TurboTax, who was taking market share from H&R Block with a better online service. And this was the bear thesis in H&R Block for a while. And what I think has become apparent over the years is that people really value that in-person experience. So while they may actually still be losing some market share even now, it's not like demand for their services is suddenly going to disappear. Realistically, this company isn't going to grow revenue much more than low single digits per year because there aren't really any major growth drivers in this industry other than them just simply increasing their prices each year and then maybe getting some additional volume from new clients as they continue to expand their retail locations. They do have some smaller businesses that they own, like Wave, which is an accounting software and did 96 million revenue last year. But overall, I would conservatively expect about 3 to 4% annual revenue growth from H&R Block long term. Operating margins have consistently been around the 22 to 23% range. Now, these may expand slightly in the future because of economies of scale. So, cost drivers like marketing and wages probably won't grow as fast as revenue will. So, the business is very stable and very predictable. And that, in and of itself, is a good quality for a business to have because then you can confidently project out the next 5 to 10 years for that business. Then the only real challenge you face when investing in them is being able to buy in at a reasonable price. So I think the best way to view this company is a company that gives you a big lump sum of cash around the tax filing season. That's when they earn pretty much 90% of their cash flow, and then basically just loses money for the rest of the year. And that cash lump sum has typically been used to pay dividends and buy back stock. So it's a very shareholder friendly company. So if we value this company using the discounted cash flow method under this basis, so using 4% revenue growth, about a 23% operating margin with a 8x exit multiple and an 8% discount rate, I do believe under those assumptions, they are actually slightly undervalued. They're probably worth around $67 per share. And this is useful information for us investors because if they were to ever deviate significantly from this price range, like say they get down to the mid to low 50s per share, then this is probably a compelling investment at that price. And keep in mind, it's a very stable and very predictable business. So there's very little uncertainty when projecting out their future cash flows, especially when you compare them to a more cyclical business. So anyways, guys, that does it for this video. I hope you did enjoy it. I just wanted to also quickly mention that the website that I've been showcasing throughout this video is my personal website. It's called tickernomics.com. And if you guys are interested in using it, I'll leave a link in the description of this video, so feel free to check it out if you'd like. But yeah, that does it for the video, so thank you so much for watching, and I will see you in the next one.